The dollar stages a massive rebound with tariff concerns dominating market sentiment ahead of the key non-farm payrolls report this week, guys. Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So the dollar bulls are back, but for how long? So in the latest week, we did see the dollar closing in positive territory because we had the concerns again being reignited by Donald Trump. And you see, guys, what I said to you about buckle up. I remember I warned you last year about the volatility that was due to come into play when Trump took that seat as the president of the United States. And we've certainly seen fireworks left, right, and center everywhere, with this man. So why the dollar staged a rebound this latest week? Because market sentiment was largely harmed by the fact that Trump said, look, the tariffs are going ahead for the likes of Canada and Mexico on the 4th of March. And then a further additional tariffs on China, another 10%. And then there's concerns, obviously he's speaking about concerns on European goods as well. So all this tariff talk has got the market uneasy once again, with Trump specifically mentioning dates as well, which the markets don't like. They're panicking, right? Which is why, as you can see here, a nice closure in the green for the dollar, right? After this consecutive decline that we saw from mid-Jan. And as I said to you guys before, that's likely to be consolidation, profit taking, but we're buying on anticipation with Trump coming into president and selling under fact. We have seen a little bit of cooling in some data points in the United States, but the US is still the most dominant force. And I said at any time, well, say at any time, but it's just a matter of timing when we're going to see that dollar resuming to the upside. Now, we've got to look at the monthly. It's important that we look at the monthly candlesticks. Obviously, a little bit bearish there for the dollar index. And remember, in our rundown before, I said that I was looking that we would stage a rebound, like a reversal doji, potentially this month. So for the month of March. And then we really see that buy momentum come into play in April. We could see it from here. The other day, we've heavily defended this zone. As I said, this zone was respected, this mid 106 region. And this is where we're likely to catch some buyers. But let's see. Obviously, we've got key data this week from the United States. If we just filter this out and just bring up US data for the moment, just so you guys can see, it is all eyes on non-farm payrolls again. Okay, so let's just jump down straight to the US data. ADP employment change was privately conducted. There isn't really massive correlation. I'm just focused on these numbers, right? And obviously the last readings, they are very much inflationary. We had a healthy average earnings. Wages have been strong, as they have been for a little while now. I don't expect to see any drastic change from that bullishness. We expect to see a decent amount of jobs still being added, 156,000, previous was 143, and the unemployment rate remains steady at 4%. Now, I can't stress how good of an unemployment rate that is, given how big America is, right? Unemployment rate of 4% is bullish. One thing to do note, though, in terms of sort of conducting some analysis myself, but Elon Musk's Department of Government Efficiency, so DOGE, they have had some significant layoffs. So federal jobs are shrinking, which may or may not feed into this data report. So let's keep an eye on that. But private sector hiring has remained strong, so that may offset that. But these numbers are important because markets are trying to ramp up rate cut pricing. Where we've seen some softening in certain data points, markets are trying to ramp up FOMC rate cut pricing. Sorry, guys. To 2 rate cuts this year. Previously we were just pricing in none, and now we're going up pricing in 2 again, which I think is a little bit pushing it, in my opinion. So these numbers, personally, I would still like to see a strong labor market. I don't see any cracks yet in that. When you look at the weekly unemployment claims, the run that we've had, obviously last reading jumped up a little bit there. But generally speaking, the numbers have been solid. So I would still like to see a generally good report this week. But be aware that we may still face a little bit consolidation because the markets are trying to balance between these themes of initially we had risk appetite because the tariffs weren't coming into play, they were delayed. Now we've got risk off again because the tariffs are in place. So there's so much sensitivity right now, which is why I explained in those previous videos why I see some consolidation for a little while for the dollar. But at some point, I do expect the US dollar to drive forward and remain king, because when we strip out all that crap for a moment, say crap is still important. When we look on the macro level, the US economy is still solid in comparison to Canada, in comparison to New Zealand, the Eurozone, the UK, Australia. This economy, without a shadow of doubts, side by side, smashes the other guys, okay? We've got technically a big bull flag here, which we could shape up to break out of. But as I say, an element of caution, just given those monthly closures. We may need to pull back first a little bit more before we push to the upside. But I am still, say, it's just a matter of time before we get that big breakout and a resumption to the upside for the dollar, in my opinion. Plenty of volatility also expected for the euro because we have a couple of key data points, big ones. We got inflation data from the Eurozone. As we know, in terms of inflation in the Eurozone, it's remained sticky. They have the situation of, as I've said to you many, many, many times, so you're going to keep hearing me say it so it ingrains into your head, is they have stagflation. Generally speaking, inflation remains sticky, and we're going to look at those numbers again in a moment on the screen. But then 2, growth is slow. 3, public debt levels are high. So consumers in the Eurozone are feeling the squeeze where interest rates at the moment are only coming down gradually because the ECB is trying to bring down still inflationary levels before they before they cut rates, because we don't want to cut too fast, otherwise we'll cause inflation to spike up again. So they're doing that gradually, but then at the same time, it's a bit of a catch-22 where public debt levels are high, and where rates are still relatively high at the moment. The economy right now could do with lower rates faster because people still have high public debt levels. So they're paying still reasonable amount of interest on that debt, their mortgages, their outstanding credit card balances, loans, all of that stuff. All right. So when we look at the CPI number, this time round is expected to cool. Now, if we just quickly look at last week, German inflation came in higher at 0.4%. Right. Inflation overall expected to cool down a little bit to 2.5% from 2.7. I wouldn't be surprised if it doesn't cool down as fast as that. On the core, and then the year-on-year CPI number expected to cool down to 2.3 from 2.5. Now, obviously, this takes us into the ECB. Now, the ECB are actually expected to cut rates by 25 basis points. Remember, they made it clear that they're going to be cutting gradually. So they've been doing that quite consistently, but they don't want to rush in terms of big cuts like we've seen in the RBNZ, in Bank of Canada, where they're cutting by 50 basis points. The economy itself could do with that, but inflation's still too sticky. We don't want to cut by 50 and make inflation spike again. Otherwise, we've got a whole other problem. So this decision, I'm expecting them... No, I'm not expecting fireworks. I think, obviously, they know that there's still downside risk to the economy. They know that inflation is still not where it needs to be right now, and that they're going to reinforce the gradual approach to rate cuts, which may provide some upside pressure for euro. The only way we get euro downside on that decision is if they say, okay, we need to pick up the pace of rate cuts. Inflation's coming down, it's improving massively. That sort of commentary would help euro to the downside. But again, technically here, as I showed you with the Dixie, we finished in the green. But remember, I've warned you guys, it's a massive key area here. Like the Dixie, that 106.50 here with euro, around 105.50, 106.00. On a weekly, price action, if you look here, is moving within a channel, right? We're moving within this channel. At some point, we are subject to a nice breakout to the downside, in my opinion. Just resume business. You know how we had this nice trend to the downside on that dollar strength? I think at some point we do push to the upside, but it's not going to be an easy one to break. Okay, it is possible, as I said, with that dollar, if we do get that dollar pullback, which would make sense, right, of how things are potentially shaping up on a price action wise, it could be possible for the euro to do this first, come up again, and then we short to the downside and get those nice short opportunity, and then we move to what we were looking for before, down towards parity. Okay, if we don't get that pullback, keep an eye on this breakout and retest of this key zone anywhere around this mid 103 region. And obviously we've got this channel here, which would set us up for that nice drop down at some point towards parity. But you've got your couple of scenarios there. Keep an eye on that ECB decision, but of course also the CPI numbers. Australia. So Aussie dollar is also on the list of volatility for this week because we do have a couple of key data points, retail sales and GDP. Why is Australia important at the moment? It's so volatile because it's subject to potential shockwaves from any tariffs on China from the US, because remember, China is Australia's biggest two-way trading partner. So anything positive that happens with China is positive for Australia. Anything negative happens with China is negative for Australia, because it means, if these tariffs do come into play and harm China, China are going to make cutbacks, and they'll make cutbacks on purchasing goods from Australia, right? It's just a natural thing. Economics 101. So at the moment, we know the RBA are still hawkish because they cut rates, but they were hawkish with it. They had a hawkish cut, as we expected, didn't we, in those previous weeks in the run up to the RBA. Now, the reason for that is because inflation's still sticky. We did see inflation last week. It did remain unchanged at 2.5%. So it is still freaking sticky. And the reason for that, a couple of weeks ago, we had strong labor market. Like, the labor market's still strong, decent jobs still being added to the economy. Unemployment rate still relatively low at 4.1%, which is really good for the size of Australia. And that's why the RBA are cautious about rate cuts, because if the labor market's still solid, right, people still out spending, stimulate the economy, price is going to remain sticky. So anyway, focus this week on, as I say, we've lost it. Let's get it back up here. this week. Focus on retail sales, expected to be bullish. Are we surprised? No, because the labour market's strong. People spending money. So retail sales expected to pick up to 0.3% from the negative number previously. GDP expected to jump up as well to 0.5% from 0.3%. Keep in mind, economy still moving quite well. Labour market's solid. Inflation still sticky. I won't be surprised if we do get some good numbers. Now, if we look at Aussie dollar, okay, we broke out of this channel. Okay, we broke out of this channel, which is key. If I just clear this up a minute, this channel that we were watching, I was watching these big rejections at 64.00. Remember I said keep an eye on that resistance in our previous video, and now we've broken out of this channel here and we're coming back down to the lower part of this range. Okay, it's very important to note this range, because here we could bounce and have that pullback, go and retest this channel, go and retest that next major zone, which is 63.00, before we potentially see some downside. If those numbers do disappoint, obviously you've got your downside scenario here. Clear this zone. We've got this area, this, you know, some liquidity here, a region around 61.50 that we'd need to take out as well before we can resume to the downside. But I know a number of big institutions are looking for that psychological 60 mark at some point. But obviously this is going to be dependent on the dollar this week. CHF, the Swiss franc. Now, we do have key inflation data, and I'm noting this because the SNB have been one of the most dovish central banks as well. They've been cutting rates consecutively. They've noted about potentially introducing negative rates because inflation's been fast falling. You know, we've had, you know, and when you look on a month for month, we've had deflation for some readings for quite some time there. When you look at those numbers. But inflation expected to pick up to 0.5%, which would be obviously bullish for Swiss franc, which would remove some concerns about having to introduce negative rates from the SNB. So obviously a bullish number, higher than expected number, will provide CHF strength. We have seen some flows into CHF versus certain peers of late, just because of that situation of concerns around tariffs. Safe haven flows. Remember, Swiss franc is a safe haven currency. Now, if we just look at dollar Swiss, obviously just as a base case anyway, you know, when you look here on a monthly, see a bearish candlestick there, which still suggests potential some downside before we see the dollar capitalizing. It does look vulnerable to some more downside. Weekly, obviously, we stayed to rebound as per that dollar bounce. So in terms of sort of where we go from here, obviously we've got this key area around sort of 90.50 up here, right? If we fail to break through this, if we fail to get that breakout and retest of this zone as well, which coincides with that sort of key area at 90.50, if we fail, if we do break through that, we're going to go up to this supply area again, around 91.50 towards 92.00. If we get rejections and we fail to break this down and get comfortable with this zone, we're likely to see this, okay? We're likely to see this and then work our way to the next zone, which would be all the way down at 87.50, which is also possible. It just depends on the dollar situation and obviously with the CHF data. So do keep that on your watch list as well. And last but not least, CAD. Wow, guys, there's so much volatility around the Canadian dollar at the moment because of obviously all this tariff talk. As I'm sure you're aware now, we've been covering it and been having our finger on the pulse for all these videos. Now, we do have key labour market data. It's important to note this because the Bank of Canada, the Bank of Canada are currently in a rate cutting cycle. And they're one of the most dovish central banks. They've been cutting quite consecutively because we've seen a worsening in generally in growth. Although the last reading picked up a little bit, the unemployment, the labour market has been softening, CPI has been softening. Everything has warranted the Bank of Canada to be as dovish as they have been. Now, when we look at these numbers here, we're expected to see a softer amount of employment change, and we're expected to see the unemployment rate tick higher, which would obviously be negative CAD. CAD's been a great short. When you look at GDP, CAD's been flying. EUROCAD, CAD is just CAD Swiss short. CAD has just been a weak currency given the economic situation, but also the vulnerabilities with tariffs. Now, when we look at dollar CAD here, I still like the idea of upside. Obviously, the monthly candle's a little bit of a weird one, given all the tariff talk. The weekly is obviously very bullish. That was a very bullish candle there. Look, at the end of the day, if we look at scenarios here, so long as the dollar doesn't have that sharp pullback, but either way, CAD's still going to be vulnerable. This is just a base case dollar CAD, but when you look at other CAD pairs, I think CAD remains vulnerable, one of the most vulnerable currencies because of everything that I've noted. Now, here with the dollar CAD, breakout and retest of this sort of mid 44 region would open up a run into these highs again. You know, remember these highs that we achieved that we were looking for before? That was really nice as we were looking for, but we'd run all the way here. Obviously, it's possible that we catch some rejections in this region here, the mid 45 region. If we fail to break out and retest this to push higher, then rejections there, bam, 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 and then we'll just get stuck in this range. Remember I said there were risks that we get caught within this range here. It's still possible, but let's keep an eye on these latest developments with the tariffs and also this data here from Canada and also from the United States. So once again, as I'm sure you've seen by now, another week filled with economic events and volatility. Have an amazing and blessed week, and I'll catch you on the next video.